Welcome to 3 Daily News, where we bring you the real stories shaping America's farms, trade, and future. Across the Midwest, the headlines are grim bankruptcies tied to farming are surging. America's heartland, rich with fields of corn, soybeans, alfalfa, dairy, and beef, is facing one of the toughest financial storms in decades. For generations, these farms have been the backbone of the country's food supply and culture. Yet in the first quarter of 2025, an alarming number of farmers couldn't keep up with their debts. The reality is sobering. Farming has always been risky, but this time, the challenges have stacked up to a breaking point. Weather extremes, massive debt loads, and unpredictable commodity prices already burden farm families. On top of all that, tariffs introduced in 2025 have added yet another layer of pressure. What may look like political debates in Washington feels very different in rural America. For farmers, tariffs are not theory. They are the difference between survival and collapse. Listen to the voices on the ground. We worry about drought. We worry about prices. We worry about equipment. We worry about financing. And now, tariffs are just another thing we're forced to worry about. Take soybean farmers in Iowa. Their survival depends on exports, with China historically the largest buyer in the world. Yet this year, China has not pre-purchased shipments for the upcoming harvest. In normal times, China accounts for more than a third of U.S. soybean exports. Without those buyers, bins filled with soybeans may sit unsold, while bills for fertilizer, seed, and machinery keep piling up. And even the tools farmers need to keep going are caught in the crossfire. John Deere, the American icon of farm equipment, has warned that tariffs on steel and aluminum will add $600 million in costs this year alone. Those expenses trickle down directly to farmers who need tractors, combines, or even small parts repaired. The price tag keeps climbing, while farm revenue keeps shrinking. This isn't just a soybean problem, it's a snapshot of the broader crisis. America's agriculture system produces far more than the nation can consume domestically. Exports are essential. If international markets close, the surplus floods local markets, driving prices down. Farmers earn less, even as their production costs soar. It's a vicious cycle. We've seen this before. During the 2018 trade war, retaliatory tariffs from China cost U.S. agriculture $27 billion in lost sales, with soybeans making up nearly 3/4 of that blow. Today, history repeats itself. Brazil has stepped in to fill the gap, surpassing the U.S. as the world's leading soybean exporter. Farmers who spent decades building trust and trade relationships abroad are now losing those markets to competitors. Meanwhile, the cost side of the equation continues to rise. Fertilizer, machinery, and fuel, the essentials of farming, all carry higher price tags thanks to tariffs on metals and other inputs. For many family farms, slim profit margins have now collapsed altogether. The stress is spilling into bankruptcy courts. In the first quarter of 2025, Chapter 12 bankruptcies, a special legal provision allowing farmers and fishermen to reorganize debt, rose by a staggering 95% compared to last year. In the Midwest, farmers filed 71 of these cases in 2024, nearly 70% more than in 2023. Behind every statistic is a family losing land, machinery, and heritage built over generations. When small and medium-sized farms fold, their assets rarely disappear. Instead, they're scooped up by massive agribusinesses. This trend accelerates consolidation, leaving fewer independent family farms. And yet, family-owned farms still make up 95% of America's agricultural backbone. The erosion of these operations means more than just lost jobs. It's a cultural shift away from the legacy of independent farming toward corporate control. For many, the promise that tariffs would protect rural America rings hollow. Instead of shielding them, farmers feel abandoned, exposed to global market swings, and rising input costs beyond their control. Farming is more than business. It is identity, culture, and way of life. And now, that way of life is on the line. Washington has stepped in with support, but the scale is uneven. In July, lawmakers approved $65 billion in agricultural spending, mostly directed toward crop insurance and disaster relief. While those programs help farmers weather floods, droughts, and storms, they do little to restore lost markets or stabilize prices. Farmers know that no short-term aid package can replace the long-term security of reliable trade partners. What they truly need is consistency, not chaos. And the crisis doesn't stop with soybeans. Consider potash, the mineral fertilizer farmers call pink gold. Nearly 90% of the potash used on U.S. fields comes from Canada, with almost all of it mined in Saskatchewan. Potash is not optional. It is the lifeblood of crops like corn, soybeans, and wheat. Without it, yields collapse. But tariffs have disrupted this trade too, raising costs for farmers while straining relations with Canadian suppliers. The big what-if question now lingers. What if Canada decided to cut off potash shipments entirely? On paper, it seems unlikely, but the implications are staggering. The U.S. consumes over 6 million tons of potash each year, but produces only a fraction domestically. Without Canada's 5 million tons, the U.S. would be left with less than 20% of its supply. Agronomy studies show that potassium shortages can slash yields by 5 to 30%, and sometimes even more for soybeans. On a national scale, even a 5 to 10% drop in corn, soybean, and wheat output could wipe out $6 to $12 billion in farm revenue. If shortages hit across all crops, the damage could reach $17 billion in just one season. This is the hidden vulnerability inside today's trade war. Unlike steel or cars, potash isn't something farmers can delay buying. It is the foundation of food itself. Canada controls over 40% of global exports, while U.S. mining capacity is minimal. Building new mines at home would take more than a decade and billions of dollars. For now, America has no alternative. Ottawa holds the leverage. Meanwhile, U.S. farming icons are buckling. John Deere has already lost $300 million this year, with projections of another $300 million loss by year's end. Its stock is down nearly 30%, and layoffs are mounting. For farmers, every repair or equipment replacement costs more, even as their crops fetch lower prices abroad. The numbers don't add up. The situation is especially brutal for young farmers. Without financial reserves, many simply cannot survive season after season of higher costs and weaker returns. Even established producers who weathered past downturns are questioning whether they can hold out much longer. What was supposed to be an economic strategy to strengthen America has instead placed farm families directly in the line of fire. Across the border, Canada is taking a very different approach. Prime Minister Mark Carney has announced a $5 billion trade resilience package, the most ambitious in the nation's history. The plan includes retraining programs for 50,000 workers, extended employment insurance, and a push to diversify export markets. For farmers, loan limits have been raised, new marketing funds are being directed abroad, and biofuel incentives are tied to canola production. The contrast is striking. In the United States, tariffs were rolled out suddenly, leaving farmers to bear the burden. In Canada, the government is spreading the pain through public policy and encouraging industries to adapt. Both nations face the same global turbulence, but one is cushioning the blow, while the other is pushing the shock straight onto its producers. And now, another flashpoint dairy. In August 2025, Trump raised tariffs on Canadian goods from 25% to 35%. While dairy wasn't directly targeted, Canada's supply management system, a program that caps production and limits imports, has become a thorn in Washington's side. Imports from the United States are capped at just 3.5% of Canada's dairy market. Go beyond that, and tariffs skyrocket to over 240% on milk and nearly 300% on butter. But Canada is standing firm. Parliament recently passed legislation preventing supply management from being used as a bargaining chip in trade talks. Repealing that law would require massive political cost. Farmers across Quebec, Alberta, and beyond see supply management as essential for survival. Canada is signaling clearly it will not abandon its dairy farmers. Trump's tariff playbook, apply pressure, demand concessions, secure a quick win, is hitting a wall. Canada's unity and legal safeguards have stalled the process. American dairy producers are still stuck with oversupply and volatile prices, while tariffs on other goods risk backfiring on United States importers. The lesson is clear. In this trade war, not every bluff pays off. This has been 3 Daily News. Thank you for watching. And if you want to stay ahead of the biggest stories shaping America and the world, make sure you hit that subscribe button to 3 Daily News. Don't miss the insights that matter most.